Chapter 9, Accounting for Receivables. Again, accounts receivables is when a business sells to their customer on credit, which most businesses do. So this is actually a fairly important and a fairly big chapter, so let's get into it. Accounts receivable is an amount due from another party, specifically, like I said, when you sell to a customer. And it can be a significant component of a company's balance sheet. A company, when it does sell, must also maintain a separate account for each customer, because you do have to track what they're buying, what they've paid, and what they owe, and so forth. You can also have receivables in other forms due from individuals, maybe that you've lent money, but a lot of times those are considered note receivables because usually you'll have a signed document. So typically it's accounts receivable is owed by customers. Notes receivable, like I said, is a formal instrument of credit, and this is maybe like when you've sold equipment or maybe a building or land and you're taking back some of the money or you lent some of the money, or maybe you lent some money to employees as an example. And then other receivables are typically non-trade. Like I said, it can be advances to employees and so forth. Accounts receivable. Okay, there's two components here. A, recognizing that account, and then valuing it. And the confusing part, I think, will be the valuing of that accounts receivable. So here we see we've made a sale to a customer for $950. And then they've received cash on credit sales here. Cash on accounts receivable. You'll notice how they'll track that through the balance. So again, you're just making it to a customer on credit here. Shouldn't be that hard. Okay, credit card sales. Obviously, when dealing with consumers, most of them deal with, most companies accept credit card sales. And so here you're going to have to debit the Visa or the MasterCard because some of them will not pay you immediately. And again, cards has changed the industry. It's been around for about 50, 60 years, whereas businesses used to lend to individuals. Now it's the credit cards are taking over that process, obviously for a fee, and it's here to stay. So let's get into what happens with a credit card sale. So here you sold $100 worth of sales, as you can see here, but you are only going to collect $96 because there's a credit card expense. So the credit card company will bill the merchandiser a fee, and those fees are negotiable. And obviously, the more volume you do, the better negotiating you can negotiate. But here you're seeing a 4% fee, so you have to account for that in your cost of goods sold if you are using credit cards. And then here you notice that they are debiting cash. That's because the company's automatically credit or debiting your account or paying you in cash. The credit card company is what's happening there. Here, they're making accounts receivable credit card company because this credit card company might not pay you for maybe 3, 5, or 10 days. So it depends when that credit card company pays you will determine how you record it. Either you're recording it as cash or an accounts receivable. And here you can see it was 5 days that they did pay you that $96. Installment accounts receivable. Again, many companies sell and make a sale of like equipment and so forth, and people will pay maybe on a monthly basis on there, and they'll be charged interest. So again, this could be an installment accounts receivable is one way of recording it. Now, I mentioned earlier that the more confusing part is how do you value an accounts receivable, and why would you need to? And the reason why is because some customers may not have paid their accounts payable. And so these uncollectible amounts are referred to as bad debt. And typically when you do sales on credit, you are going to have some bad debt expense. Some people will not pay you. Their circumstances change, or maybe it was actually intentional fraud. So there are a couple methods for accounting for these bad debts. It's the direct write-off method and the allowance method. And the direct write-off is when you determine it's bad debt, you're just directly writing it off to that account. You notice just to the specific account on there, and you're noticing you're doing it to the accounts receivable because they hadn't paid you, so you need to reduce the accounts receivable now and notify that as a bad debt expense. Here, maybe you recovered this individual's money, you had priorly written it off, and now you need to put it back into accounts receivable, so you take that bad debt, reverse it, and now you notify it as being paid. This is very seldom does this happen. Usually when you write it off, it is a bad debt, by the way. Okay, we have matching versus materiality here. The matching principle requires expenses to be reported in the same accounting period as the sales they owe. It sort of goes in alignment with the revenue recognition principle. And materiality states that an amount can be ignored if its effect on the financial statement is unimportant to business decisions. So the direct write-off method usually does not best match sales and expenses, and it's not accepted for financial reporting purposes. Now, many businesses do this, but it's not according to GAAP. But many businesses do not do their financial statements to GAAP. However, we are learning in this class the GAAP methodology, so let's explore this. So we have to use what is called the allowance method. And so at the end of each period, whether that be the month, quarter, or year, we have to estimate total bad debts expected to be realized from a period sales. And so we won't know which accounts, but we know some accounts well. And so we'll put some estimate out there. And again, what this does is you're now recording this bad debt during that period that you really do expect it. You'll actually write it off as maybe some later period, but it's putting a fair value on that balance sheet here, as well as your expenses for tax purposes here. Understand that whenever you see the word estimate, because you're going to start seeing this word more and more, understand that that is also management's playground. Management will play with those estimates, and sometimes will, I hate to use the word manipulate, but will play with those and alter their estimates, sometimes to fit their financial needs rather than their true accounting needs. And so it can be a playground and it can be abused, so be aware of that. So what happens in the bad debt? Here you had credit sales of $300,000, and at the end of the year, 20,000 sales remain uncollected. But based on your experience of Sidmer, estimate that 15 of its accounts receivable would be uncollected. So what you're doing is, you notice at the year end, you're allocating $1,500. But are you really attributing it to any particular account? No. So what you're doing is you're attributing it to an allowance for doubtful accounts. So you have to create another account in your chart of accounts called allowance. And so what this is a reserve for some future bad debt that you expect to be writing off. And so this reserve, this allowance for doubtful accounts, is a contra account, sort of like depreciation that we had studied earlier. And you'll notice that the accounts receivable is a debit because it's an asset, but here you're crediting it. So it's going to lower the value of your total accounts receivable down to $18,500 on the balance sheet. And so you will show those three numbers on the balance sheet. So here's how they're showing it. They're showing the 20,000 as accounts receivable, less for doubtful accounts at 1,500. So the net is 18,500. So on your balance sheet, under the current assets section, you are going to show the reserve, the sale as it was on the actual dollar amount, and then this estimate. Now you're getting an estimate net value on there. So later on, you do write off that $500, whereas now you're taking it off the accounts receivable. Now you're reducing that allowance for doubtful accounts. So now you're not noticing you're not writing it off to a bad debt expense because you did that in an earlier period. You're actually reducing that allowance for doubtful accounts, and now you're also notifying that on that specific individual's account. So you notice how this is now getting reduced, and the accounts receivable is getting reduced. This can confuse students, so I would recommend spending a little bit of time here and getting used to this. This is obviously going to be tested also. So the actual write-off, not when you estimate it, but the actual write-off actually does not affect the accounts receivable because you had reduced it also here. So you notice it went from 20,000 where you were on the 31st, you had the 20 and 1,500, but now you reduced it by 20, but you reduced this by 520, and that leaves the same net realizable value on those accounts receivable. And then recovering, you would just simply do as you've done before, but now you're just reestablishing it in that allowance for doubtful account. Again, this doesn't happen as often as the book would like you to believe. Okay, so how do you estimate these bad debt expense? And there's two primary methods. One is the percent of sales, and another one is the percent of accounts receivable method. And here you have the percent of accounts receivable or an aging of accounts receivable. I'm going to stop here and start the next section because this becomes very important, especially this aging of accounts receivable.